Welcome to the Lynette Zang YouTube channel, where we support community and sound money globally. So help us build this channel. We need you to make sure that you subscribe, hit that bell, give us a thumbs up, leave us a comment, and share so that we can really grow this channel as quickly as possible on a global basis. So today we're going to talk more about interest rates. We're going to talk about the derivatives underlying that, which is so important for you to understand, because my personal opinion is that this is really what will most likely topple the system and be big enough that the central banks cannot print their way out of. Okay, so let's just dive right in. But before we do, I want to remind you guys that, of course, they can change this, and they probably will come with some kind of stopgap measure. But the government shutdown deadline is this Friday. So if you're watching this on Thursday, that's tomorrow. We'll see what they do. They'll probably kick the can down the road. The markets don't even give a crap about it anymore. But let's dive right in. Because our wonderful Larry Summers, and you guys, if you've been watching me for a while, know that I'm not a big fan because of his work back in the late 90s on derivatives, allowing them no oversight. Yeah, great guy. But anyway, he sees meaningful chance that the next Fed move will be a rate hike, not a rate drop. And this is coming up more because inflation is proving sticky. In other words, it's not slowing down as much as they would like, so that you're noticing it. They don't want you to notice it because then you make different choices, right? Markets start to speculate if the next Fed move is up, not down, because we handed this over. We handed the Treasury market over to traders back in 2013. Interest rate options reveal some small hedging of Fed hikes, but wow, let me tell you, inflation is not going away. In fact, I am fully prepared to put my technical neck on the line and say we've already seen the beginning of hyperinflation. But you got to ask the question, who is really controlling the interest rates? The Fed can control the overnight interest rates that they charge, but the markets control the rest of them. Now, what you're looking at here is the 10-year Treasury volatility index, which they stopped showing us back in 2016. Thank you very much, because we don't need to know this. But what I want to point out to you is that the global financial system is based on the 10-year Treasury. That's the foundation. And back here, you see how these are all little dashes? Which means that the price, if you wanted to buy or sell a Treasury in that day, there was not going to be a whole lot of price movement because the Treasuries were going into stronger hands. 2008 hit, and so instead of dashes, we had small lines. But here you go, 2013, now we've got this volatility. So what this is showing you is that the foundation of the global monetary system is on a foundation that's moving like this. And if they stop showing us that back in 2016, 2017, how bad is it now? We know that the liquidity in that most important market has been failing since 2015. So you need to understand that Wall Street doesn't give a crap about stability. They just care about making a little bit of money. And I think this TYVIX shows that transition better than anything else that I've seen. And the whole system is definitely deeply at risk. And let me show you what great old Larry Summers allowed, because these are interest rate derivatives, IRDs. And this is the weekly notional amount. Now, whenever you hear or you see nominal or notional, what that means is that you have no real idea of the true value that is at risk. This is just an agreed upon price, right? And that's all this is a contract. But look at how this has grown from a half a trillion, so 5 billion. And this was back in 2013 when they really did hand this trading market over to Wall Street, up to 8.4 trillion. This is on a weekly basis, people, a weekly basis. Because it should be very clear with all the crisis that we've been through that Wall Street is far, far, far more important than Main Street. But Main Street, you and me and everybody else will pay the price for it. Now, this is the number of trade accounts. So this is the notional contract value, what the market says that it's worth. And then this is the trade count. And you can see, again, from 2013, how many more trades there are in interest rate derivatives. They're playing with the foundation of our global system. Back in 2013, it was 7.3 thousand a day. Now it's 51.5 thousand. Oh, I'm sorry, a week versus a week. Can you see how much more that's grown? They don't give a crap about stability. They only care about making a little pickup in money. But again, I cannot repeat this too much. We have no idea of what the true value is at risk. That's true. The FDIC says it. The BIS says it. The Fed says it. Everybody admits we have no idea of the value that's at risk. But what we do know is that 71.4% of all derivatives traded are interest rate derivatives. And since we had, about 15 years of ZIRP, zero interest rate policy, a lot of these contracts were put in then. I guess I can't guarantee it because this is such an opaque market. I can't find this information, but I'm going to tell you, just like all the banks are underwater, remember how this goes. Oh, I think they put it here. They did. Okay. Interest rates, market value. As the Fed and all other global central banks have been raising interest rates, all those bonds and anything that's debt, mortgages, auto loans, any debt instrument is underwater. That was any debt that was laid in during ZIRP or anywhere below where interest rates are right now. So they're all underwater. If you know you're declaring bankruptcy, what difference does it make really what you do, right? Well, let me show you. Because all we are seeing is the very tip of the iceberg. Now, what you're looking at here are global interest rate derivatives, notional outstanding. And so notional, again, that's just an agreed upon market price. It really has nothing to do with the underlying value of the asset. And you can see that it's up near all the highs. These are all from 2013 when this started. And so far, what they're admitting to, because they can do derivatives on top of derivatives too, is 573.7 trillion in global interest rate derivatives outstanding. And here's the market value, right? I think it's really interesting because we're going to be talking more about this. I've talked about it so much. But you have the notional value of 573.7 trillion, and yet those contracts, when they do all their accounting tricks, turn into 14.4 trillion. What? So they don't want you to realize what's really going on. And if they left it at the 573.7 trillion, then they would have to hold back reserves. And they don't want to do that. So by matching contracts and doing all of this misty stuff, they can make 573.7 trillion in agreed upon contracts down to 14.4 trillion. A whole lot fewer reserves need to be withheld. But I cannot remind you of this enough. No one knows the true value at risk, and they all admit that they have no idea what that value is. But the banks generate 69.7% of their trading revenue, of their income from this trading revenue. This is from the OCC, the Office of the Comptroller of the Currency. You guys know I use their work all the time. Derivatives in the FDIC insured banks that have roughly a penny of every in their reserve to insure every dollar's worth of your deposits up to 250,000. So trading for banks is critically important. And you can see how much that's grown since 22 to 23. And it's up near the highs. I mean, there have only been 1, 2 other times that it's been higher than that since 2008 when the system died, when the great financial crisis occurred. I think this is really interesting. So really knowing that you have no idea all of the bets, because that's all a derivative contract is. It's just a big bet that you cannot convert into the underlying. And it's just agreed upon values until it freezes, which, by the way, is what created and caused the great financial crisis, was a freezing of an interest rate of actually a CDO, which is a backed security with mortgages. But that's another story for another day. Just understand that derivatives killed the system last time. They're going to kill the system this time. It's going to be too big for the central banks to create money and hide it. And most of that is held in 3 of Wall Street's biggest banks, those that are too big to fail, which frankly is a whole lot of garbage. But 3 Wall Street mega banks hold $157.3 trillion in derivatives. Well, the global GDP is $56.7 trillion. So more than the entire world, more than all the money, GDP, all the money that flows through everybody's hands on a global basis. How do you bail that out? Now, sweep accounts were created in 95, and this is through Reg D. And that allows, when you make a deposit into your checking or savings account, the banks have the right to sweep that into sub-accounts in their name and then use that for all your trading. How safe do you feel now? Okay, and you can notice how much that's grown ever since then. So with world GDP at it's 31.7 trillion in 96, and derivatives 20 trillion. Look at how much that has grown by the end of 22. So not even the end of 23, it's much bigger. World GDP 100.56 trillion, derivatives in just those 3 FDIC banks at the end of 22 was 190.98. So it's gone up even since then because this, I lost my laser. Okay, here's my laser. Because this is current to October or November of 2023. So derivatives versus the GDP was 189.92%. And that's just what we know about. What do we not know about? In the quadrillions. What's above quadrillion? I'm not even sure. In the quadrillions. How do you bail that out? You can't. So I got to ask you, are you ready for a bail-in? Because there's only so much that you hold in the system and boom, they tell you can't have it. Tell me what you're going to do about that. We've seen that. They've tested in Greece and Cyprus and Portugal, many other places. And just going back to the Office of the Comptroller of the Currency, this is the notional amount of precious metals, i.e. gold, contracts. And where you see this huge jump here, it's because they were forced to value them differently starting in 2022, getting ready for the full transition into Basel III. So these were all big fat lies. Now my question to you is, do you believe this lie? Because I don't. I definitely don't. But does it have an impact on the spot gold market, which is what we've been trained to think of as gold? It's not gold. It is just a contract. It's not this, right? But it can certainly be used to suppress and control the visible price that we see. But how many times can you be lied to when you do not know the truth? And obviously the answer to that is every single time. Can you see how they can easily influence the market? And we're not even really seeing what's going on here. And my question is, hey, why isn't spot gold at $600 an ounce? It's certainly not going to reflect the fundamental value. And I just did a video on that on Tuesday. So if you didn't see that then, go back and watch how you value what the true fundamental value of an ounce of gold is. Because what you're looking at here is just manipulated garbage. It doesn't mean anything. It's a big, fat lie, an admitted lie. But when do you want to know that it's a lie? When do you want to know the truth? I say hallelujah and thank goodness that they actually are suppressing the price of gold, because when you're at this kind of level, this is just a raw 1 ounce Liberty, right? It's going to be reflective of that spot market. But when you go into the collectible market, that is a physical only market. That's where you see the truth. I've shown it to you many times in the past. I will continue to show it to you in the future, but you're going to find a whole lot more truth, and these have all broken out. So when do you want to know? I want to know while I still have time to prepare. So if you want to show your support for this channel and help us grow it, please help us grow this. And I love all the kind comments. I really appreciate them a lot. But give us a like, give us a thumbs up, share, and leave us a comment. Make sure that you show everybody that you can get to. Sit down and watch these videos, become educated so they can put their best interest first, just like I want you to put your best interest first. And if you really want to support the channel, again, subscribe, hit that bell. We'll let you know when we're going online. And don't forget to send your questions to questions@LynetteZang.com, because we're going to try and answer as many of them as we can. Together, we're doing this together. We can build that global community. We can make a difference. We can build those local communities. Community is everything. And until next we meet, please be safe out there. Bye-bye.